Welcome to The Explainer. Today, we're putting on our equity analyst hats and diving deep into a true fundamental valuation mystery, Helmerich & Payne. You look at the headlines and you see a stock that's absolutely tearing it up, right? But, when you actually pull the financial filings and do the rigorous valuation work, a much more complicated and honestly way more fascinating story emerges. We're going to bypass the hype, look straight at the reported numbers, and see what's actually powering this machine.
To make sense of it all, we're going to hit 5 key areas: the recent stock surge, unpacking the valuation mystery itself, comparing their revenue growth against profitability, digging into dividends and cash flow, and finally looking at the overall health of the balance sheet.
All right, part 1, the recent stock surge, momentum versus fundamentals.
So the stock has posted a staggering 115.25% trailing 12-month return. I mean, wow, that is a massive move for a $3.77 billion company. It's exactly the kind of top-tier momentum that makes the market stand up and pay attention. But as we all know, momentum in a vacuum, it doesn't tell us the whole story. We need to look at the track record.
And when you map out the historical performance year by year, it is a total roller coaster. Look at this volatility. We're talking severe whiplash, from a brutal 44% drop back in 2020 to that massive triple-digit gain of over 115% in 2022. This kind of historical chop immediately begs a really fundamental question about how the market is actually pricing this asset right now.
Which brings us to part 2, unpacking the valuation mystery. Is the price right?
So here's the puzzle we need to solve today. With these explosive returns, is this stock actually fairly priced? Or is it dangerously overvalued? Does the underlying business model and cash generation justify a price tag of $37.78? Or are investors just getting completely swept up in a momentum trap?
Let's look at the classic valuation metrics, and right away, one number just leaps off the page: the PE ratio. It's sitting at a negative 11.84. Yeah, negative. So despite the stock's massive popularity and those triple-digit returns, current earnings are actually in the red. Plus, that forward PE of over 103, that tells us the market is pricing in some seriously optimistic future growth to make up for today's shortfall.
Let's move to part 3, revenue growth versus profitability, checking the engine's output.
Okay, so if earnings are negative, where on earth is the momentum coming from? Well, check out the top line. The revenue growth is accelerating aggressively. Over a 3- and 5-year period, the compound annual growth rate was a solid 19.9% and 23.7%. But look at the trailing 12 months. It has rocketed to an impressive 48.21%, pushing total revenue past the $4 billion mark. They are selling a lot more and a lot faster.
But this perfectly captures our core mystery. You've got this explosive 48% revenue growth on one side, right? But it's completely contrasted by an anemic net profit margin of just 0.95% and a deeply concerning negative 12.17% return on equity. It's like a car engine running super hot but barely moving the wheels. They're generating huge sales, but they're really struggling to convert those top-line dollars into actual shareholder equity.
To put that into stark perspective, the trailing 12-month net income is sitting at a negative $316.67 million. Ouch. This completely explains those wonky negative PE ratios we saw earlier. When your bottom line is bleeding over $300 million, your traditional earnings-based valuation models, they just kind of break down.
All right, part 4, dividends and cash flow, looking inside the fuel tank.
So with net income deeply in the red, the absolutely crucial question is, are they generating real cash? Now, Helmerich & Payne still offers a 2.65% dividend yield, which sounds great. But look under the hood. The standard payout ratio is listed at 100%, and they haven't had any consecutive yearly increases recently. Basically, they're stretching their resources to the max to keep this dividend alive, relying entirely on cash flow instead of bottom-line accounting earnings.
But here is the saving grace. They actually have positive free cash flow. Over the trailing 12 months, they generated nearly $180 million in real cash, which gives us a pretty healthy 4.76% free cash flow yield. This right here is the oxygen for the business. It brings the free cash flow payout ratio down to a much safer 55.61%. So while the accounting profit looks terrible, cold hard cash is definitely still flowing into the business.
Moving on to part 5, overall financial health. Checking the balance sheet stability.
Let's fire through some of these balance sheet metrics because they show a surprisingly sturdy foundation.
A debt-to-equity ratio of 0.78, that's a very manageable debt load. Add in some strong liquidity ratios, like a current ratio over 2 and a quick ratio of 1.58, and it proves they've got plenty of short-term assets to cover immediate liabilities. Honestly, it's a remarkably solid setup for a company that just reported a $316 million net loss.
So how do we weigh all this? Does a solid balance sheet and almost $180 million in positive free cash flow justify a higher valuation, even with those glaring negative earnings staring us in the face?
This is where we do the rigorous valuation work. To find the true intrinsic value, analysts will often toss out those skewed EPS numbers and build a discounted cash flow, or DCF model. A DCF looks strictly at that positive free cash flow, projects it out, and discounts it back to today to tell us what the core operations of the business are actually worth.
And the results of this DCF run are super fascinating. Basing the valuation purely on the company's cash-generating power, it calculates a fair value of $45.74. That means the last closing price of $37.78 is actually trading at a pretty notable discount.
To be exact, that discount translates to a 17.41% margin of safety. Let that sink in for a second. Finding a 17% margin of safety in a company that's currently posting massive net income losses, that's a huge deal. It just goes to show how incredibly powerful that $180 million in free cash flow is to the underlying intrinsic value of the firm.
So, as we wrap up this explainer, here's the million-dollar question you've got to ask yourself. Can management actually turn that massive 48% top-line revenue growth into real bottom-line profit before the market corrects? Or is this 17% margin of safety actually just a value trap waiting to spring? The fundamental data is all laid out, but how this mystery unfolds is entirely dependent on what the business does next. Think about it.